Hello and welcome to our video lecture for Chapter 9 Liabilities. The first topic we're going to cover is current and contingent liabilities. Current liabilities, as you're probably familiar with, are due within 1 year or within the operating cycle if longer, but mostly we have it within 1 year. We have two different types of contingent liabilities, which would be those that we know the amounts and those that we estimate the amounts. So current liabilities, these are examples of what you'll see. Accounts payable, short-term notes payable, sales taxes payable, accrued liabilities, which you are aware is an adjusting account, right? That's what we put adjusting journal entries in. You have payroll liabilities and unearned revenue, which you know that is a liability, and that's also you owe services. And the current portion of long-term debt, that's important. You have to reclass the amount of the next 12 payments on your long-term debt and record it as current. So accounts payable is basically what is owed for the products or services, and it's pretty much like a credit for purchase of inventory is mostly what you'll do. Remember, accounts payable is towards vendors and accounts receivable is towards customer. So accounts payroll turnover is a ratio that we use, and basically that lets us know how liquid the company is or how quickly they can pay off their AP through cash. So you should have in your Excel template accounts payable turnover, which includes purchases from the supplier, and you divide that by your average accounts payable. Remember, beginning balance plus ending balance, and if you divide that by 2, that would give you your average accounts payable balance. And notice our T account, beginning balance plus purchases minus your cost of goods sold equals your ending balance. You should have both of these in your Excel template to help you when you are taking the exam. Then other ratios that you should have is the turnover expressed in days. So here you have 365 days, and you take the actual AP turnover and you put that as the denominator. So again, this should be in Excel and this should be linked, right? Because you know this number, and whenever you calculate the AP turnover, you should link that cell to this cell. Short-term notes payable, similar to accounts payable, is due within a year, and basically that's what you borrow cash possibly to purchase an asset, and you have to accrue interest expense. Remember, a notes payable, the difference is the promissory note. And notice the promissory note has interest, and you know that this interest equals principal times rate times time. So you should also have that in your Excel. So let's work through some problems here. So these are the entries that we're going to basically cover the purchase of inventory that costs $8,000, accrual of interest expense, and payment of a 10% short-term notes payable, which is due within 1 year. So at this point, we have the $8,000, so we're going to add that to inventory, and then we're going to say notes payable short-term. That's how we purchase the inventory, through this note. Next, if our fiscal year ends on September 30th, at year end, the company has to accrue the interest at the 10%. So our $8,000 note at 10% for the 9/12, since in September, so we've actually used 9 months out of the year, we have to pay interest of $600, and we're accruing it at this point because we haven't paid it. So we're going to credit interest payable. Now, when the entry to record the actual payment of the note when it becomes due, which was a year later, you have the notes payable short term for $8,000 that you initially booked, and then your interest payable, you have to pay that, the $600. And then basically that was your 9/12 here, so you have to remove it from interest payable. Then you have to accrue the other 3 months. So the additional $200 is accrued, and then you have your total cash, which would be the $8,000 plus 10% of 8 is $800, and you see our $800 adding up here. You see our $800 here adding, sorry about that, right here to these two amounts. Now, for sales tax payable, usually retail sales, you have the sales tax payable ranges from 5% to 7%. And as you can tell, in certain areas in our state, it changes. And so basically, you have to collect this from the customer and then remit it to the state. So basically, you are a pass-through entity, because you have to collect it and then give it to the state. So here, if we had sales at Home Depot that was $200,000, assuming all in cash. And then they collected an additional 5%. So this $10,000 is $200,000 times 0.05. Then of the sales tax. So the store would record the sales as follows. They have to pay $210,000 out, and your sales revenue is only $200,000, and then your sales tax payable is the additional 5%. And notice, to get the cash, we multiplied 1.05, one singling that it's 100% that you have to pay plus the 0.05 of the sales tax payable. So accrued liabilities basically result from expenses incurred but not yet paid. Remember, expenses incurred and revenue is recorded when earned, and this kind of gives us our basis. So here, if you haven't paid them, salaries and wages payable, interest payable, and income tax payable. We've already gone through this one now. So payroll liabilities are also considered part of employee compensation, and basically you have salary, wages, commission, and bonus. You can get paid for several different things. So now when you're accounting for all forms of compensation, you basically have to put your total salary expense, and then what you do is you put all of your payroll taxes. So here, employee income tax payable, FICA, and taxes and salaries payable, so they all total. Notice we have federal withholding tax, and that's only by the employee. Then we have FUTA, Federal Unemployment Tax Authority, and then this is by the employer and the employee. So there's several different other payroll taxes that you can see as well. So basically your salary expense is your gross wages, and then we have to create several payroll liabilities: income tax payable, FICA, and salaries payable. Now for unearned revenue, note it can also be called deferred revenues, and basically this is when you're collecting revenues in advance. So think of like a gift card. So basically you go to Best Buy and you purchase a $100 gift card. You give Best Buy the $100, and they have an unearned revenue because they haven't really given you anything for it, just the card. So if you go back, they will earn the revenue once you make whatever purchase you're going to. So here we have on December 15th that we collected $300 for a round trip ticket from Dallas to Los Angeles. Notice the date. And then on December 28th, the customer flies to Los Angeles. So the entries are, as of December 15th, you paid $300 for the ticket, and here we can call it air traffic liability or airfare liability. Then once we go on the trip, we take it out of that air traffic liability, and then we go to ticket revenue. And notice we did half of it, because basically at December 28th, we pretty much just have half of that. Then on January 4th, when we return, because that was our first leg of the flight, so now the second leg, when we return to Dallas, then what Southwest will do is record the other part of the revenue. So here's your air traffic liability debited and your ticket revenue. And notice once the revenue has been earned, the balance in the liability account would be 0. And notice the two entries for the flight there and for the flight back. So let's work through a problem now. We have that the publishing company completed the following transactions for one subscriber. So we sold a 1-year subscription collecting cash of $2,400, plus we also collected sales tax of 9%. That's a bit high. Then on November 15th, we paid the sales tax to California. And then on December 31st, we made our adjusting entries. So let's go through these transactions and any liability that we would have to put on the balance sheet for December 31st. So here, first let's record the subscription fees in advance. So we get cash, and notice we have 9%, so we added 1.09. Unearned subscription is the $2,400, and the sales tax payable is then the $216. Now when we pay the sales tax, we're gonna take that payable off the books for the $216 and show cash. And then at December 31st, when we earn the revenue, we're gonna take the complete earnings off, and notice that here we've only earned 3 out of the 12 months. Oops, excuse me. So this is just for 3 out of the 12 months, so that we're allowed to record that $600 as subscription revenue now. The current maturity or current installment of long-term debt has to be moved to the current section of your balance sheet. So basically your long-term debt is paid in several different payments, and then the amount of the principal payable within that 1 year is what you have to reclass. We call it reclassing entries. So other liabilities that you may have to estimate are estimated warranty, payable, and contingent liabilities. So warranties may be for 90 days or greater, right? And then what the company has to do is record a probable warranty expense that when it records the sale, right? So we need to do the matching principle, revenue and expenses, match the revenues and expenses in the period that it was earned or incurred. So that would be our matching principle. Then contingent liabilities, it depends on future outcomes for past events. Pay attention because you'll have to probably identify this on your exam. This might come up as an exam question. So in accounting, what we have to do is accrue, disclose, and you don't have to do anything if it's unlikely, but we'll go through some of that now. So let's start with our estimated warranty payable. So here we're talking about Black & Decker, and they manufacture power tools, and they made sales of $100,000, all of which were subject to product warranties. So we are assuming that in the past years, between 2 and 4% of products proved to be defective. So now we estimate that 3% of the sales will require some type of repair and maintenance. So to record the warranty expense, we're going to take the $100,000 and we're taking our new estimate of 3% to get $3,000 warranty expense and estimated warranty payable. Now assume that the defects that we actually worked on were only $2,800, right? Black & Decker would then have to record estimated warranty payable of $2,800 because that's what they spent, then reduce the inventory by $2,800 to replace any defective products. So you would replace the defective products, so that has to come out of inventory. And now let's move on to contingent liabilities. If it is probable, then you must accrue it. If it is reasonably possible, then you have to disclose it in the note disclosures, in the notes to the financial statements. And accrue it, remember, you're going to book some type of debit expense and you're going to credit some type of payable. And if it's remote, you're lucky. We don't have to do anything. So probable, reasonably possible, and remote. And then for probable, you accrue and disclose. For possible, you just disclose. And for remote, you don't have to do anything. We'll stop our lecture here and continue momentarily.